Welcome to the Deep Dive. Today, we're jumping into a world that's, well, both incredibly exciting and, frankly, a bit scary. Investing in startups.
It really is. It grabs headlines, promises huge wins.
But it's also packed with risk. Our sources for this deep dive, though, they give us a pretty clear roadmap.
Yeah, they don't just hype the potential, they get real about the challenges.
And importantly, they offer practical ways to, size up these opportunities.
Strategies you can actually use.
So our mission today,
Yeah.
we want to help you cut through that noise, figure out how to spot the promising ventures.
And how to navigate those pitfalls we mentioned.
By the end, hopefully, you'll feel more informed, more ready to look at this space with real clarity.
Let's do it.
Okay, so first off, the allure. What actually pulls people into startup investing? I mean, a big part is that potential for just massive returns.
Well, absolutely. It's that chance to get in on the ground floor.
Like being an early investor in Coster.
Well, who? Think about the giants now. Uber, Airbnb, Facebook. They all started small. Tiny, even.
Right. Just an idea.
And our sources point out that's the dream for many investors today, isn't it? Catching that next big thing.
That feeling of, if only I'd invested in Google back then.
Exactly. It's a very powerful motivator, almost like wanting to rewrite history a bit.
It is strong. But, and here's the reality. Check, our sources hammer home. Most startups don't make it.
Not even close. The failure rate is incredibly high.
Yeah, the data's pretty stark. Something like, 70% of tech startups fail within just a few years?
That sounds about right. It's a tough environment. High mortality, as you said.
Okay, so let's unpack that side of it then. Given those odds, what are the real downsides? The risks.
Well, the biggest, most significant risk, honestly, it's losing everything.
Your entire investment.
Your entire investment, poof, gone. You have to be prepared for that possibility. Zero return.
And why is it so common? What are the typical hurdles?
Startups face this gauntlet of challenges. They might not understand their market well enough.
Or run into catch?
Exactly. Lack of funding is huge. Or they just get steamrolled by bigger competitors.
So the business might just stall, never really scale up.
Precisely. Or it burns through its money or gets outplayed by established companies with way deeper pockets. It happens all the time.
And beyond the risk of total loss, there's another big issue. Liquidity. Or rather, the lack of it.
Right. That's a crucial difference people need to grasp.
How so?
Well, think about public stocks. Yeah, you can buy or sell them pretty much instantly on an exchange.
Right, click a button.
With startup investments, it's usually not like that at all. There's generally no ready market to just sell your shares.
So your money is essentially locked up.
It can be, yeah. It's very difficult to sell your stake until the startup has what's called an exit.
An exit.
Okay.
What does that actually mean in practice?
An exit usually means one of two things. Either an IPO, an initial public offering.
Going public on the stock market.
Right, where shares become tradable for everyone. That's relatively rare, though, and takes years.
Okay, and the other path?
More commonly, it's an acquisition. A bigger company buys the startup.
Ah.
But the catch is, these exits might take many years to happen, or they might never happen at all.
Leaving your capital tied up indefinitely. Wow.
Yeah. It's a significant risk.
Okay, so given these very real dangers, total loss, no liquidity, here's where it gets really interesting.
Yeah.
How do smart investors deal with this?
How do they spot the winners?
Exactly. How do they identify promising opportunities and sort of hedge against these risks? What's in their toolkit?
Well, the sources are pretty clear on this. The very first thing, the absolute key starting point is research the founders.
The people behind the idea.
The people, their capabilities, their vision, their grit. It often determines everything. The success or failure really hinges on them.
It's like betting on the jockey, not just the horse you said earlier.
Yeah.
Makes sense. So what specifically are you looking for? Just a fancy resume?
Oh, it's much more than that. You need to dig deep. What's their actual experience? Their background?
Have they done this before? Started a business?
Exactly. What's their track record in entrepreneurship? Are they genuine experts in this specific field?
Have they built something successfully? Maybe even exited a company?
All crucial questions. And here's a key insight. A strong, resilient team. They can make all the difference.
How so?
Because things will go wrong. Plans change. A good team can pivot, navigate those tough challenges, adapt, and still find a way to grow and scale.
They're the problem solvers, the engine.
Absolutely. They can turn potential failure into survival and then success.
Okay, founders first. What's next on the checklist?
Number 2, Understand the product or service. Really understand it.
Sounds basic, but I guess people can get caught up in the hype.
They can. You need to go beyond just what it does.
So what are the core questions then? Like, what problem is it actually solving?
Precisely. Is it solving a real problem? A genuine pain point for customers?
Not just a minor inconvenience, but something people actively want fixed.
Yes. Because the logic is simple. The bigger the problem, the bigger the potential demand for the solution. This really highlights how vital a clear value proposition is. What unique benefit does it offer?
Yeah.
And achieving product market fit.
Product market fit. That's that sweet spot, right? Where the product just clicks with the market.
Exactly. It's like finding the perfect key for a very specific, important lock. That's when things can really take off.
Okay, founders, product problem. What's third?
Third is market size and growth potential.
So not just how big the market is now.
But also how fast it's growing. Is the pond getting bigger?
Makes sense. A startup needs room to grow.
Definitely. If you're targeting a tiny niche market that isn't expanding, your upside is naturally limited, isn't it?
So you're looking for?
Ideally, you want a large market, yes, but also one that's growing rapidly. Think, maybe 15–20% growth per year or even more.
And is it just about size and speed?
Well, smart investors often look for something else too. An uncontested slice of that market, sometimes called a blue ocean.
The space where they don't have to fight established giants from day one.
Exactly, where they can gain traction more easily.
Interesting. Okay, point 4.
Number 4, evaluate the business model. How does this company actually plan to make money?
Right. Is it sustainable? Can it actually be profitable?
And crucially, is it scalable? Can revenue grow much faster than costs as the company gets bigger?
What kind of models work well there?
Well, our sources point to examples like subscription services. They often provide steady, predictable, recurring income. Investors tend to like that.
Predictability is good.
Very good. On the flip side, a model based just on one-off sales can be tougher. Customer acquisition costs can be high, and income might be less consistent.
Makes sense. Okay, that's 4. What's the final key evaluation point?
Finally, number 5, understand the potential exit strategy.
Back to the exit. So thinking about the end game right from the start.
You have to. How does the investor realistically get their money back, potentially with a return?
So asking, is the plan to eventually go public via an IPO, which you said is rare?
Right. Or is the more likely path an acquisition by a larger company?
Which is more common.
Much more common. Understanding this potential endgame is vital. It helps you gauge the actual probability of seeing a return on your investment down the line.
It gives you a sense of how you might actually realize those gains you're hoping for.
Precisely. It's not just about investing and hoping. It's about understanding the plausible pathways to getting your capital back, hopefully multiplied.
Okay, so pulling this all together, what's the big picture? Investing in startups, it clearly offers that shot at amazing rewards.
A huge potential upside, no doubt.
But as we've really dug into, it comes with these significant, very specific risks. It is definitely not for the faint of heart.
Absolutely. But by doing your homework, really researching the founders, understanding the market, the problem, the business model, the exit,
And being clear-eyed about the risks.
you can make much more informed decisions. It moves it away from pure gambling towards, informed speculation, calculated risk.
And the really successful startup investors, they get this duality, don't they? They see the incredible potential.
But they also fully understand and accept the high chance of failure. They go in prepared for either outcome.
Eyes wide open.
Completely. And this leads to maybe the most critical piece of advice from our sources, one that applies to any risky investment, really.
Which is?
First, make sure any startup investment is just one part of a broader, well-diversified portfolio. Don't put all your eggs in this one basket.
Diversification is key.
Always. And second, the golden rule. Only invest money that you are genuinely prepared to lose. Completely.
If it went to zero tomorrow, you'd be okay.
You have to be. If losing it would significantly impact your financial well-being, you shouldn't be making that investment.
Sound advice. So as a final thought for everyone listening, thinking about all these evaluation strategies.
What's an overlooked problem out there?
Yeah. What overlooked problem in the world today do you think is just ripe for a startup to tackle? And maybe, just maybe, how would you start to assess that venture using what we talked about today?
Something to chew on.